Ooh, does accounting have you spooked? This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so one big topic, or two areas, but one big topic, auditing and are you ready? SAS is 143 and 145. So if you just listen passively, pause whatever you're doing for a second and just listen to this, because these pronouncements are effective for periods ending on or after December 15, 2023. Therefore, if you do audits, these are effective for the calendar year audits you're going to do this upcoming busy season. So if you haven't looked into these two, SAS 143, there's actually 144 also, but 143 and 145 are the two big ones that I'm very concerned about. 143 is auditing accounting estimates and related disclosures. The areas that they focus on and requires a separate assessment for inherent and control risk. Now, if you remember the risk assessment suite that came out 104 through 111 years ago, it was probably almost 20 years ago, 18 years ago, they really didn't separate inherent risk. In fact, at one point, when I did a search, I couldn't even find inherent risk. And now I was happy they finally started identifying the inherent risk and requiring you to separately assess them. Now, we're going to talk about risk assessment later on, so just bear with me to talking about risk assessment a little bit now. In the past, you were able to just assess them together and kind of move on. Even though the forms that people were using had it separated, you could have theoretically assessed together. Now it's saying you have to assess these two, inherent and control risk, separately. Okay, it spells it out and it talks about it even more under the next one we're going to talk about later on. It emphasizes the auditor's further audit procedures needed to be responsive to the reasons for the assessed risk of a material statement at the relevant assertion level. Now, this was changed a while ago. I know that there's a certain practice aid out there that we used to use that other people use. In the past, it wasn't required to be done at the assertion level. Now they're requiring you to make sure you assess risk down at the assertion level. You know, completeness, existence, accuracy and classification, valuation, disclosure, those type of things. You have to understand and assess them down at the proper level. Requires the auditor to evaluate, based on audit procedures performed and audit evidence obtained, whether the accounting estimates and related disclosures are reasonable in the context of the applicable financial reporting framework. Now, we always had to consider auditing estimates, but now they're focusing on it a lot more. And one of the previous episodes, you probably remember, I talked about significant estimates. This is requiring you to dive deeper into it and have an understanding and do a retrospective review of your estimates. So even if you had an allowance for doubtful accounts, it might not be a significant estimate, but if you have an allowance for doubtful accounts, that's an estimate. Theoretically, depreciation is an estimate. Let's stick with allowance for doubtful accounts. You're required to go and look back at your estimate and compare what happened over the year in comparison to the estimate that they had in place. Now, I'm just picking allowance for doubtful accounts. It could be an impairment, it could be a lawsuit, it could be environmental. But when a management creates an estimate, we have to go do a retrospective review, and well, first we have to audit the estimate to determine how they came up with that estimate. And us redoing the calculation is not auditing an estimate. What we're very good with is getting an Excel sheet and then just doing certain recalculations. That's not auditing the estimate. You have to understand management's decisions that went into this. So for those that are in industry, I know that we're talking a lot about auditing, but you have to understand, the reason why I bring this up is we're going to be picking on estimates a lot more this year. We're going to be asking a lot more questions. I just had a conversation with a client the other day about a revenue consideration that they're doing and the estimate that they're doing, and I said, I'm going to need a memo And they said, well, what do you want a memo for? I said, I need a memo on your accounting policy as it relates to this. Well, I'll just give you an email. I said, no. I said, your accounting policy has to be documented better than just an email to me. And I hate pushing back like that because we work with our clients very closely. But we're going to be requiring a lot more documentation for those that are in industry. So this isn't just about auditing. This is going to impact you that are in industry too. Get ready for the next one, even if you're in industry. 145, understanding the entity and its environment and assessing the risk of material misstatement. Now, we've had to assess the risk of material misstatement for the longest time. And going through peer reviews, one of the things that bugged the AICPA is that people really didn't have a good understanding and a good application of the risk of material of the risk assessment process. Now, if you use third-party practice aids and you say, and you're the auditor, and you say, all right, I'm not going to spend the money this year and I'm not going to update my practice aids, or I'm just going to roll over last year's. Don't do that this year. Of all years, don't do that this year particularly, because the risk of material misstatement and documenting it is changing a lot this year. A couple of the areas to focus on is requirements and guidance related to obtaining and understanding the entity's system of internal control and assessing the control risk. So we need to really start beefing up our documentation of understanding the control environment and doing adequate walkthroughs to support it. Now, a walkthrough and documenting the control environment is not just a narrative. It's not just, oh, so-and-so goes to the bank and picks up the check and then they come through the front door. Sometimes they come through the back door. That's not it. You're supposed to be identifying the key controls and then doing a walkthrough of those key controls. And you're supposed to have a walkthrough, and under the new standards, a walkthrough of the high-risk areas. Okay, they got rid of the moderate risk areas and low risk, you didn't have to, but the high-risk areas. Another area is guidance that addresses the economic, technological, and regulatory aspects of the markets and the environment in which the entity and the audit firm operate. Okay, so now it's pulling in other attributes that are not only within the organization, but things outside the organization. A revised definition of significant risk, a revised requirement to evaluate the design of certain controls within the control activities, components, including general information technology controls. We as auditors have never been real strong, as an auditor particularly, have never been real strong at understanding and documenting the IT environment. Okay, informational technology, the computer environment. Now I know a lot of our clients are just using QuickBooks or they're just using another simple system. Either way, you have to consider the depth of the IT environment, and you may have to bring in a specialist to document it. Particularly if there's certain situations where the systems are talking to one another a lot, or if they've had cyber issues that went on, cyber activities that went on, you may have to bring in a specialist in. Now, there's a list of 6 of them that we can go over. Reach out to me. I'll give you a list of 6 of them that you should consider. But my recommendation is think about bringing in a third party, an IT specialist to go over this. People in industry are saying, why? He's telling us that this affects us, because you're going to have other people now involved and other people that might be going a little bit deeper. I have a fairly significant client. They have a simplified accounting process in their general ledger system, and every year I have to try and talk to them about IT, and they're like, come on, why are you bringing these people in? I'm like, you don't understand, you have a fairly significant company here, and I have to make sure we have a full understanding of your IT environment. There's a new requirement to separately assess inherent risk, control risk. You heard me talk about that before, okay? There's a new reference that I actually hate this word. If you saw me talking with Frank at a recent session we were doing, that they came up with a phrase, it's called the SCADA bead. You think in a profession we could finally start coming up with cool phrases. I said the lawyers have force majeure and estoppel. We have SCADA bead. That's what they came up with. And you're sitting here saying, Brad, what are you saying? Can you say that again? Yes, SCADA bead. What does that mean? It stands for significant classes of transactions, account balances, and disclosures. So they came up with the phrase SCADA bead. So if you hear this or if you see it referenced somewhere, that's what they're talking about. And what they're going to require now is another phrase they come up with, a stand back requirement. And I always say the only time I ever heard stand back was when my father was about to hit the TV to try and fix it so it wasn't wavy anymore. A new stand back requirement intended to drive and evaluation of the completeness of the auditor's identification of significant classes of transactions, account balances, and disclosures. So what does that mean though, Brad? So now you have to take a specific account area, let's say, and break it down to the SCOTA bead. Is it a significant class of transaction, account balance, or disclosure? And then look at it from the drill down further then to the assertion level. So this is part of the reason you really can't use the new forms. That in and of itself, use the old forms. That in and of itself is an indicator that you haven't updated and you may not have a full understanding of the new guidance. So as you see, I mean, I have 10 minutes just to go into this. This is really a significant area and a significant change. And I know a lot of people haven't been focused on it. We went through a heavy biz tax season into a EBP audit season, and it's been a lot of stuff going on. So it's time now though to step back because the audits are going to be starting and you have to start planning them. So those are the two areas I wanted to cover today. And in closing, I want to share with you a few upcoming NJCPA accounting and auditing events. There's a free webinar for NJCPA members on navigating the new auditing standards. It's available on November 16th and 21st. And there's more in-depth auditing standards update webinar being presented by Renee Rampula on November 28th. Register at njcpa.org/events. If you're looking for some in-person programming, several of the NJCPA chapters are holding A&A sessions this fall. I just came from the Union chapter. See the schedule at the njcpa.org/chapters. And lastly, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.